on income, on our income tax deductions. So that's what we're going to talk about. So during your lifetime, okay, you do get some sort of income, or you're eligible for an income tax deduction through the use of a charitable donation. Now, if you itemize, okay, that might be important. If you are taking the standard deduction, maybe not so much. But a lot of people you deal with in this class are, we're assuming, are very, very wealthy. They give stuff away because it's cheaper to give it away than it is to keep it, right? Or they're trying to find some kind of tax write-off because if they maintain that, that's the situation. Now, if you transfer at death, okay, you do not necessarily get an income tax deduction, okay, for any year earned in the year of your death. What happens is you do get a charitable deduction on your estate tax. Now, this is important. Why is this important? Think about this. It's important to distinguish your income tax versus your estate tax. Because, why? When it comes to charitable donations, what's the standard deduction right now? 27 something, or 12, what is the standard deduction, 12.5? So let me look that up for you real quick. I should know this is top of my head. I'm sorry?
I think, is that the single?
For single.
For singles,
14.8.
14.6 is what's it?
Okay, so you're gonna take this, anything, if you itemize deductions over the standard, then you wanna itemize because you get a larger deduction on your income tax, correct? What about for your gross estate? What would be comparable to our standard deduction on income tax to our gross estate tax? Our lifetime exclusion, correct? So although we may be under the limits, what is it again? 13.62 or 13.8? Where is it?
13.6.
Okay. Thank you so much. My mind's not working today. Now, I might have a deduction, okay? I may have assets less than a year where it doesn't matter if I get that charitable deduction or not because I'm not going to pay any taxes anyway. But in the year that I die, or for whatever example, if I can use that charitable deduction to minimize my income taxes, which I guess it doesn't really matter to me because I'm dead anyway, right? But for people who are left over, then it may be better, right, to give during lifetime than it is to transfer at death. Even though you do get this unlimited charitable deduction, okay, which means there's no limit on the amount you can deduct if you give it to charity. So it's always important to consider what your charitable objectives are, and also the timing, okay, when you want to give this away. And then some details here. If you give property, okay, and you split it between a charity and a non-charitable beneficiary, you gotta make that distinction, okay, on certain tax returns. I'm not gonna quiz you on the form or the tax return, but keep that in mind that you don't have to donate all property just to charity. You can split it up between a non-charitable beneficiary. All right, so what qualifies for a charity? Sandon's got a charitable fund. What's it called?
The Sandon Needs Money Fund.
Okay, so boom, is that a charity?
Yeah.
Okay, does that qualify under section 170, 503C?
I am a structured organization.
Okay, we'll talk about
I'm
your
a
types of charitable
501.
organizations.
I'm a 501c3.
Oh, okay, all right. So the IRS, okay, IRC code does define what qualifies as a charitable entity for income tax or gross estate tax deductions. Okay, so the state, right? If you want to donate property to the state, okay, obviously they're going to say for sure that qualifies for charitable deduction, but it has to be for public use. Okay, you can't be restricted. You can't say, hey, I only want certain people and I want a charitable deduction. It's got to be technically for public use. Okay, a corporation, a trust, some kind of fund, a foundation, organized in the United States. This is going to be important. I saw a couple questions on your assessments that looked at this. Okay, there are operated exclusively for these following reasons. Okay, religious, charitable, scientific, library, amateur sports competition. Now that was pretty cool. So if you want to give some money to the Olympic team, that might work. And then anything that prevents cruelty to children or animals is what is defined as a charitable entity, right, for our deduction purposes.
Can you go back?
Sorry. And again, all of this is in the book. Now, look, I really highly recommend you go through and work some of these, or at least read through the scenarios in the chapter, because there's a lot of deductions we'll talk about today. So right now, we're just talking about what qualifies as an qualified charitable organization. State, corporation, trust, or some kind of other entity that does exclusively these types of items. We good? Okay, any kind of posts for veterans, like the veterans, what's it called? The veterans,
VA?
no, not the VA. What is that place?
The Wounded Warriors Fund?
Yeah, that would probably qualify. I'm talking about the veterans.
Veterans
They,
of-
they have like, they go and they hang out.
Veterans of Foreign Wars?
The DFW, yeah, the
The
post.
VFW, yeah.
Whatever, okay, you know what I'm
VFW,
discussing, right? Where they actually go hang out,
That's
okay, for veterans, things like this.
yeah.
If you are part of the Shriners Hospital, okay, you are a domestic fraternal society, okay, but you also operate for the same purposes as you would if you were a corporation, exclusively for those. So these would qualify for charitable donations, you know. If you wanna donate to a cemetery company, okay, but it has to be for the entire cemetery, it cannot be just for a specific plot. Okay, you can't like get found like a huge monument to somebody you love and then call it charitable donation. It's gotta be accessible to the entire lot. Okay, so we're getting an idea of what we qualify for as charitable organizations. We're trying to find what we can give to before we talk about taking any kind of deductions. Okay, in your book, this is listed. Anytime you see a table like this will be in your book. But it gives you a really good idea of what's going on. No political groups, no homeowners associations, no foreign organizations, so keep that in mind. No social clubs. Sorry, Sam, you're,
I'm not an individual, I'm a fund,
well,
once you start funding me.
are you operating exclusively for any of these purposes?
He could be doing it for educational purposes.
I'm a fraternal society,
He looked like that. He said,
and I would also say it is preventing cruelty
Well, it's
to
not,
children.
it's not for his educational purposes, it's for the general public educational
Yeah,
purposes.
he's doing it for general public educational purposes.
He'll give 1% of it away.
Prevention to.
Yeah, we're gonna talk about how much you have to give away to maintain your status.
Oh, you have to give a certain amount.
66,
You can't hoard it all.
That's
70% goes to
fantastic.
administration fees.
Okay, so take a look at this, wrap your head around what's going on, this is in the book, okay? All right, so if you are not sure, the IRS does have a website where you can search for charitable organizations, okay? So if somebody tells you that they are a charitable organization, they look solid, okay, and you give to that, can you take a charitable deduction? And they're not. Can you still take that deduction? Sheridan says no. Avery says no.
I mean, I feel like that would just lead to a lawsuit, cause if they presented themselves.
Yes, for sure, but can you, if you got duped into it, can you still take the deduction?
I mean, technically, yes, because you're an innocent in the matter, but I honestly, yeah, there we go.
Yeah, you have to go take a look, and now, because we looked at this, they have a certain filing status with the IRS, okay? It will be listed on there as a charitable organization, so it's up to you, if you wanna take this or recommend doing a charitable donation, that you verify that it is a charity for these purposes. Okay, so we're gonna break up our types of charities, okay? In the most basic sense, it's either gonna be a public charity or a private foundation. And this is broken up into two types, an operating foundation and a non-operating foundation. Okay, now this is gonna be important because depending on if you're an operating foundation or a non-operating foundation, you are subject to different limits of contribution. You can't just give all your money in one tax year and take all that 100% deduction, all right? So obviously, if you are more hands-on with the charity, you're gonna be allowed a larger deduction. okay, or are able to contribute more money subject to certain limitations. If you're donating to that type of entity. If you're donating to the entity that is really just kind of like, hey, I'm a rich person, I have a foundation, so I can fly my kids around the world and buy a jet and collect money for a purpose, but I'm not distributing 85% of my net income to charitable purposes, like immediately within the year, then you're not gonna get, the government's not gonna allow certain people to donate large sums of money to you, subject to their AGI. Now, if you are a public charity, this is what you probably heard me say before, it's what I call the boots on the ground. This is when you're actually giving sandwiches, you're giving soup, you're doing whatever you need to do, right? To actually, you're helping people, okay? That's what they call a public charity. And then there are 2 tests that you want to qualify for this. Now, you cannot be just a business and claim to be a charity. A lot of your support has to come from grants or donations, things like this, right? So just to make sure that people aren't trying to operate their business and get a tax deduction or a tax favor treatment. So there are limits, I'm gonna let y'all go through this in the book, about how much needs to be provided through grants, okay, donations, X, Y, Z. But this is the big one. This will come into play here in a little bit, whether it's defined as an operating private foundation or a non-operating private foundation. This is really cool. This is what you want. I think have we talked about this much in this class yet? Okay, so let's say I start a foundation. Now, I'll break this down. I'm not sure if I'm getting ahead of myself, and forgive me if I do, because I don't want to double repeat myself. But in this scenario, I'm a foundation. My job is to collect money, okay? And if you donate money to me, okay, then you get a charitable deduction if I qualify for a certain purpose. Whether operating, let's say I'm a non-operating private foundation. Now, what I do is I'm like a funnel. I can't draw. Okay. And all I do is I go around and I get a bunch of rich people, okay, for example, to donate money to my foundation, and then eventually I have to donate this to charities. I can't just keep this money, right? So I go around, because I got a lot of rich friends, I collect things, right? I collect people. I'm a really rich person, okay? I collect people. And that's what my purpose as a foundation is to do.
Terrible.
Now, this foundation itself has costs, correct? I gotta rent the gala out, somebody's gonna organize this function, somebody's gotta order the food, okay? Somebody's gotta go and present to a group of people to try to get everybody to want to donate to my foundation. So guess what happens? All this money that comes into the foundation gets to be expended for that. Okay? Now guess if you have a private foundation, who do you get to appoint to do all this nice cool stuff? Fly to Switzerland because you want to, focus on those kind of people to donate to your charity. So you need a private jet, you guys take the hotel, you gotta buy food. Who do you, as the operator of the owner of that foundation, who do you get to choose? Who would you choose?
My family.
Who? Family, friends. Okay, so all the chair on the foundation's dime, you get to fly around the world, okay, and it's completely legitimate because you are working towards a charitable purpose. So this is why they do this. You get to buy the jet, or at least rent the jet, you stay in the hotels, you get to go travel. All this stuff is part of the foundation because you are eventually, if you're following the rules, okay, you are getting money to go on to benefit people who need it, whether it's religious, educational, whatever your purpose is. So if you ever come across that or want to be involved, okay, you're looking for jobs, try to see if you can get on the foundation. They may not pay a lot of money, but they usually have a lot of really approachable benefits. Okay, so private foundations, okay, up to date, by far are the largest, biggest charitable planning instrument. They by assets outweigh actual charities by a ton. Now, there is something called a donor advised fund. Okay, this is another vehicle that you can operate for which you can donate to and get a charitable deduction. So it allows you to donate to a fund, okay, get immediate tax deduction. The fund is professionally managed, there's investment income, XYZ, but you get to choose. Typically that fund's gonna have a purpose, maybe it's for Boys and Girls Club, all right? You donate to this, you get to choose the timing of those donations. Maybe you may even get to, at exactly what it is, advise on what projects, okay, that they're looking at in there, that you want for their Boys and Girls Club. But in any case, this really is you don't have to be a charity or a foundation. This became a product that a lot of companies use that help funnel money again to charities, okay? So this is a charitable investment that you get a deduction and you kind of get to dictate where it goes without having to set up a whole private foundation or set up a whole charity, okay? You can do what they call a donor advised fund. Okay, so let's talk about this. So now we've defined foundations, we found out what a charity is, what a foundation is, okay? Those are the two main receptacle vehicles, right, that take in money that help benefit the charitable cause, okay? So now we're gonna talk about the different types of gifts you can give and how they're gonna be taxed, okay? Or actually you get your income tax deduction. So if you give cash, okay, you can deduct the full amount of the cash minus any benefit you received. Okay, so maybe a bargain sale on your behalf, whatever. If you receive any kind of benefit, you cannot get the entire deduction. If you just gave cash straight up, you get to deduct the amount of that cash, subject to certain limitations. If you go out there and do some kind of service, right, well, good for you. But you only get to deduct the amount of unreimbursed expenses. Okay, if you go out there, maybe gas, maybe you had to buy some trash bags because I don't know what you're doing, you're picking up on the side of the road, whatever the charitable purpose is, okay, that's the scenario. Now, gifts of property, okay, are a little bit different. Now, break this up into long-term capital gains and ordinary income property. Okay, anything held over a year plus, okay, is gonna be long-term capital gain property. Anything other than that is defined as ordinary income property. So if it's ordinary income property, it's the lesser of the adjusted basis or the fair market value. So typically, which one's higher, fair market value or adjusted basis? Fair market value is gonna be, typically gonna be higher. So you get the lesser of the two, if it's short-term or ordinary income property. If it's long-term capital gains property, okay, you've held this property for over a year, maybe it's stock, okay, that's been appreciated, you've had it for over a year, it is defined as long-term capital gains property. You actually get to deduct the fair market value unless it's a non-operating foundation. Okay? If it's an operating foundation or a public charity, you get to deduct the full fair market value. If it's not, then you're limited to just the adjusted basis. Okay, because these guys are not really, I mean, they're collecting money, but they're not doing a lot of the work themselves. Okay, so that's gonna be, you don't have quite an incentive to donate to that kind of foundation because you're limited to the adjusted basis. If you have tangible personal property that is unrelated use for the charity, okay, that's a situation where it's a lesser of the fair market value or the adjusted basis. So what this means is that I wanna go to the Boys and Girls Club and I wanna hang a Picasso up there, right, because I think it looks really cool, right? That's what they call tangible personal property for unrelated use, okay? They're not gonna sell that painting's not part of the charitable cause for whatever foundation I was working with. That's what this is talking about, okay? So if it's not for direct use, you have to get the lesser. Okay. So, cash, service, okay, gifts of property. These are gonna be the three types of items we can donate to a charity. Okay, anything else? Okay, it's gonna fall under these properties. So now we're gonna talk about, okay, these different types of organizations. How much deduction you can take, okay, depends on your AGI, your adjusted gross income. Okay, so your limits, okay, based on your adjusted gross. So the higher the adjusted gross income, the higher the limits you're gonna be. Now, some of these, depending on the type of gift, whether it's cash, long-term capital gains property, okay, and whether you donate to a non-operating foundation or an operating foundation, are gonna limit how much you can actually take a deduction for. Okay, some you can only take 20% of your AGI, even if the property's worth a lot more. They'll only allow you to deduct 20% of your AGI. Some are gonna be 30, 50, some are gonna be 60%, okay, subject to your adjusted gross income. That's how much a deduction you can take. Some people got a lot of just net investment income. They don't need all their W-2 money, for example, so they'll donate a lot of property and get a large tax write-off in that scenario. And it all depends, okay, if you're, again, that the idea is they want to incentivize you to donate to charities or foundations that are more hands-on. If you're a non-operating foundation, okay, you're probably gonna be considered one of these lower organizations. Okay, I'm trying to rationalize why they're given certain income limitations or tax deduction limitations, okay, depending on what's going on. Take a breath. Are we following along so far? Is all the pieces starting to keep them coming together? Okay, so this is the book. Comes directly from your book. Okay, if you have access, this is probably going to be one of your key resources for this chapter. Okay, it's going to identify, okay, the type of property that you're going to donate. It's going to discuss, okay, the valuation purposes, fair market value or adjusted basis, okay, depending on, right? Then it's going to talk about what percentage of your AGI you can deduct. Going forward, in this scenario, long-term capital gains property or tangible personal property, real property, if it's for a non-operating private foundation, you can only use the adjusted basis subject, right, to these AGI income limitations. Does that make sense? So this right here is going to be a really good use, okay, when you're trying to look at, bless you, how much can I deduct, okay, depending on what kind of operation it is and what kind of property I'm donating. Okay, this is all on the lines of income tax. So I'm making money in 1 year, how much can I deduct on my income tax this year based on how much I'm giving away and who I'm donating to. Anyone have any questions? Yeah. Is that working for you? Okay. Now here's a special election, okay, for long-term capital gains property. So let's say we know now that I have limitations based on my AGI, how much I can deduct, correct? Well, they allow you to take this first year, okay, the now, times 0, and you can go out to, well, it's actually going to be 5 years, carry forward. Okay? And this helps you because if you do have a very large piece of property you can't split up and you want to donate it to charitable cause, but you can only deduct so much, okay, you're just going to get hosed, right? You're just going to get hosed because you're 20%, it's a 20% entity? No, they're not. They're going to make allocations for that. They're going to allow you to go 5 years forward. So I can take deductions for this year and for the next 5 years, okay, just to make sure I recoup the value of that property as an income tax deduction for charitable purposes. Okay? Now, again, we're subject to long-term capital gains only. Okay, this is not ordinary income property. This is not necessarily cash. Okay? If I choose the lower, the adjusted basis, okay, and the adjusted basis is not always lower. Sometimes you can step up in basis from inherited property, X, Y, Z. If I choose the adjusted basis, then they will raise my limit to 50% of the AGI. Right? So I get more. I get to do more, but the value of the property donated is less because I'm using the adjusted basis. Okay? If it's fair market value, then you're limited to 30% of the AGI. If you're taking the higher value of the property, they're going to lower your AGI limits on what you can take an income tax deduction for. But they do allow for the 5-year carry forward. So again, if I donate a big piece of property that cannot be separated, they're not gonna hose me in the entirety of the time. They will allow a 5-year carry forward for a charitable deduction. Now, you have to decide, and you will have to decide on the exam, okay, which is the better way? Is it better for me to do a lesser value, okay, but higher to subject AGI limits? Or is it gonna be better for me to take the higher value of the donation, but I can only deduct 30% of it, okay, every year? It's gonna depend on what your AGI limits are for the next 5 years too, correct? Because if I have a low AGI in the next upcoming years, I'm going into retirement, right, for example, then it may not be worth me donating this property a certain manner. Of course, you have to look at your fair market value and the adjusted basis, so that's pretty much a no-brainer. And then consider the time value of money when you're making these decisions. Exciting stuff? I bet y'all are wishing we had a case study work day today. Okay. We're getting there. We're all about halfway done. Okay. So let's do this. Let's look at these rules. Okay. And whoever can get this, I'll get some bonus points. See if you've been listening. If adjusted basis, you get 50% of AGI. If it's fair market value, you get 30% of AGI. Okay, those are the rules. Give a 5-year carry forward. And the rules. Let's see if anybody's awake and listening. Saying right now, he gave up?
Yeah.
All right. Marilee has an AGI of 50,000. She has a rare antique her father gave her with an adjusted basis of $200,000 and a fair market value of $1 million. Okay, assuming her AGI will remain the same for the next 6 years, which election should she choose? You don't want the bonus, we don't have to participate.
You take the lower, right?
Well, I'd like to see some. I'd like to see some support behind this answer. I mean, yeah, there's two options, right? A adjusted basis or fair market value. How come?
The lower one would be better.
Yeah, sure. Talk to me about it. Tell me why. She's like, what do you mean tell me why? I thought this was multiple choice. No, this is a short answer question.
Fair market value, but with the 6 years matter for, is that 5-year carry forward?
All right, so let's look at this. We got the time 0, 1, 2, 3, 4, 5, correct? And our AGI is going to be, let's say, what is it, 50,000? If I'm going to do this myself, we're not going to get, there's no bonus points involved, okay, but we'll just work this out. Okay, all the way down. All right, so if I choose the adjusted basis, how much do I get to, what's my possible that I can deduct? 50%, right? Okay, and if I choose fair market value, what am I limited to? 15,000. I can only carry forward 5 years. Now, if I can carry forward a lot longer, it may take more sense, right, to make the option choice. So, what do you think, just from right there? What does it look like? Adjusted basis, right? Because we're gonna take 25,000 a year as opposed to the 15,000 a year, even though we had a higher amount. If there was more time, okay, it would make more sense. But we ran out of the 5-year carry forward period. So ultimately speaking, she's gonna be able to deduct, if my math is right, okay, $150,000, okay, even though the adjusted basis and the property value of the property is worth $1 million, That's interesting. She's taking a big loss on this. She must really not like that antique, or it's haunted or something, right? But there's a huge loss. Why not sell it? Why would you not sell this antique and donate it? How much was it with cash? If we gave cash to a charity, what percent of our AGI could we? Why would I not sell that item and just give cash?
Still a big loss.
Still a big loss? Well, I wouldn't be losing any value because I can only donate 30,000, right, a year, but it's cash.
The cash would be in a gross estate.
Cash would be in a gross estate. What else? Remaining cash would be in a gross estate. What else? What's one thing you always could be a gift? No, you sell the property. Yes, there's gonna be a gain on the property. How much was it? The adjusted basis was how much? And the fair market value was, so she's gotta pay the tax on this 800,000 right off the bat. Okay, so sometimes it does make sense, and there won't have a lot more information on here about her case, but you always got, sometimes it makes sense just to donate property, especially sometimes appreciating property if you're trying to remove things out of the gross estate. Okay, so when it comes to valuation of the property itself, okay, what they consider fair market value is anything that a fully informed willing seller and fully informed willing buyer would agree upon. Okay, so you can't just be pulling numbers out of nowhere, okay, when it comes to establishing fair market value. A lot of times products will have blue book values, we're talking about cars, but sometimes paintings, things like this will also have blue book values. And then you will probably mostly need to get an appraisal if you donate property in excess of $5,000. Now, some of us may just want to donate to the church, okay, $20 a week. I don't necessarily need to, right? We'll talk about that, I think, next. I really, really recommend you go through you go through the book and look at some of the examples. Because this can get a little hairy. We're just covering the topical situation right now. Introducing you to the concept. But this chapter, you'll need to put a little work in. If you haven't been reading the chapters, at least go over it and understand the examples. All right, so if I have property and it's under certain limits, I need different types of confirmations or affirmations that I've donated property. Okay, if it's under $250, sometimes if it's a check, you actually write a check to your church or whatever, you can usually see that on your bank statement. That's proper enough if you're gonna take the donation. If they come audit you, okay, you know where to access that information, or you just get a receipt. Okay, sometimes that'll work. Sometimes contemporaneous acknowledgement from the organization. They will have a form available for you, it's certified. Okay, so you need something that's just not just somebody's word of mouth. In other scenarios, okay, when we start donating a little bit more, it's gonna take a little bit more than just what I say. Okay, not just, hey, this thing is worth this much, I'm taking this deduction. You may have to get an appraisal. And typically, if it's between a certain value, 5,000, over 5,000, you will definitely have to get some kind of appraisal to validate the price or the value of the property. Front row's going to sleep. You all right? Everybody's good? Okay. What's a bargain sale?
Selling at a price less than the fair market value.
100%. So we can also do this to a charity, right? Hey, I want some money back. I have property worth $100,000, okay? But I don't want to just give them the $100,000. Hey, I need something back, right?
Can't you do this with family?
If your family is defined as a charitable, that's got to be right, for charitable purposes, operating, a public charity or a foundation. That's defined like we did at the beginning of the class. So, your charitable contribution, if you sell something on the cheap to the church or whatever else, all right, is the difference between the sale price and the fair market value. That makes sense, right? Just a discount, okay? It's worth 100, I sold it for 60, I get a $40,000 deduction. Now, assuming I do not have an adjusted basis in this, okay? If I do have an adjusted basis, what do you think is gonna happen? Think about this, because you're still making a profit, right? You're still getting money back.
Income tax?
You have to pay income taxes, right? On the difference between, right, what your basis is and the value of the property. Now, because part of the value is a charitable donation, they're gonna lower your basis down proportionately. Okay? If I gave 40% away to the charity, then they're gonna lower my basis proportionately, right, to reflect my gain. That make sense? And this is how they do it right here. So capital gain treatment for a portion of a sale. Okay, the sale component is what? Let's do this. Properties, I think the example we have next, property's worth 100,000. Okay, they sold it for 60. Okay, this is the sale component. So this means I took in $60,000, okay, cash in hand. This is my charitable donation. Okay, now we're gonna talk about the basis next. I have an example, I don't wanna jump too far ahead. Now, what they're gonna do is they're gonna discount your basis. Because this is capital gain, right? How much I sell it for minus my basis. That's the general formula for capital gain. Am I correct? Now, because a portion of this went to the charity, what I'm gonna do is I'm gonna discount my adjusted basis. Because I didn't sell it for 100, I sold it for 60. So they're gonna proportionally reduce my basis too. So I still have to pay some long-term capital gains tax on that, but it's not gonna be quite as much as it was, okay? So that's all that they're doing here. This is the general formula for capital gains. How much I sold it, minus my basis. Now we're looking at this discount. Okay, in this scenario, what is my discount?
60,000 divided by,
Yep. Okay, that's all that is. Okay, that's my discount. So 60%. All right, so that's all that this is doing. So I'm taking the capital gain formula, applying a discount to my basis to lower it down, because my sell component has also been lowered down. So what would the capital gain on this one be? You got everything you need right here. Matter of fact, I think I've done most of this for you, so I'm gonna erase it.
$42,000.
22,000?
42.
42,000 would be what, my capital gain? What was my discounted adjusted basis? Yeah, you're correct, if I remember right.
18,000.
Right. This is what my adjusted basis was, 60% of my original basis, which is 18,000. Okay, subtract that from my sell component, still on the same capital gain formula. Okay, so now, instead of capital gains being 70,000, if I would have sold the property, okay, I would have had to pay capital gains on 70,000. I only now have reduced my capital gains to 42,000. Okay, and pay taxes accordingly to that number, depending on what's actually 20%. Yeah, so that would be the scenario. But do we get this now? Make sense? Okay, it's still following the capital gain formula. We're just applying a discount to the adjusted basis.
you go back, sorry?
Sure. Okay. I think this came directly from the book also. Okay, so if you want to review this, this is going to be directly in the book. Okay. This one's going to have a calculation also. We're not going to go over it, right? But there are calculations in the book where you'll have to define how much of this donation is subject to charity. So this is going to be a lot, very similar to a CRAT. Okay? But this is what they call a charitable gift annuity. So this is something you do in life, when you donate property, right, to the charity, and they agree to pay you annuity for either a certain period or for life. So you can see where we're going with this, is that how much of my retained interest, okay, that's gonna reduce my charitable donation. Because if I get $1 million, I retain an interest of 300,000, okay, then I'm getting $1 million deduction. Okay, they're gonna remove my interest that I actually received. I'm not a charity, okay, from the donation. Now, if you haven't taken the income tax class, income tax, but the insurance class, you understand that any annuity payment is a proportion that's return of principal to you. So this entire annuity payment is not taxable, income tax, that's just a portion of it, and they'll establish that. And then again, the principal is removed from the donor's estates, they get a life annuity, income for their life, okay? And maybe this is because the charity is the remainderment in this process, if we're talking trust terms. But this setup is pretty simple compared to other complicated charitable functions. I need to record this. Okay. Let's start here. If your employer provides life insurance benefits to you, anything above $50,000 is going to be considered income, and you have to pay income taxes on that. If you decide to name a charity as your beneficiary, okay, those additional income taxes will be avoided. Okay. Life insurance, okay, follows the rules of ordinary income property. So if I die, life insurance, okay, I have a final tax, I have a tax return that last year, okay, that I died. When you're filing my taxes, okay, this is a scenario, you'll follow the ordinary income property rules. So it's gonna be the lesser of the fair market value or adjusted basis, okay? And they'll figure that out by how much money I put into it. Those of you taking the life insurance class on permanent policies, you'll have a cash value, and then you'll have a death benefit, and a lot of this, the difference between is gonna be your adjusted basis, or actually the cash value of your adjusted basis. I wanna ask you questions, but understand that there are, sometimes you're required to take required minimum distributions from IRA accounts. Yes, IRAs, and some of these have been lifted, but if you wanted to, because that means you have to take this distribution. You can no longer let that money earn interest. If you want to, you can donate those distributions to a charity and receive a charitable deduction, but I probably won't ask you questions. You might see it on the assessment, okay, give it a look, but don't worry too much about this one right here. Okay. Okay. So a pooled income fund is just another tool. Simply, it's exactly what it is. They pool a bunch of income together. Okay, they'll give some of the owners some money back, and a lot of times what's left over will be donated to the charity. Just understand that this is what's out there. Right? If you don't have a lot of money to donate, you don't want a complex plan, you don't want to set up a trust, okay? This is a simple process. If you just have maybe you don't even get a really good estate tax or income tax deduction. Maybe you just wanna give to a charity to understand that this type of product exists. It's gotta make sure that the charity can continue the contributions to you, because if you're receiving income in this, okay, they mismanage it, there's nothing left for the charity, and plus you don't get the money that you basically give for it. Okay. You remember how we had CRATs? What is the term for CRAT? What does a CRAT stand for?
Grant to retain an interest.
Yes. So what happens in that scenario?
The person making the trust keeps a portion of interest in the property and then gives rest
To a remainder? Yeah, to somebody that's a beneficiary, right? This is the exact same thing, except for in this case, the remainderment is gonna be a charity. So you donate money, property, okay, could be money, could be stocks, could be business, could be whatever it is. You retain some kind of annuity from it, right? There are limits. The annuity has to be at least 5%, but not more than 50%, okay, of the fair market value. So you can't leave everything to the charity, okay? And you can't take it all for yourself. Is basically what they're saying, right? In order to receive a charitable deduction for this. You can do it for life. You can do it for a term of up to 20 years if you're not gonna do it for life. Understand that this is fixed, so there are no more additional contributions after inception. And when you calculate your annuity and how much you're getting back, the remainder interest of the charity has to be at least 10% or greater of the initial fair market value. If you retain a life term for it, then it would still be included in your gross estate. Okay, so CRATs, with GRATs, we had GRITs, we had GRUTs, okay? Same thing for charities. CRITs, CRATs, CRUTs. Okay, this is basically, we've already discussed this. This is the way it looks. Okay, the way it's set up. These are the requirements. Somebody gets some money, okay? At the end of it, the charity gets what's left over. Okay, CRUTs. Okay, same concept. You retain an income stream, the remainder of the property gets donated to a charity. This one's a little more flexible though, because you can contribute afterwards. If for some reason you're not getting the money that you're promised, because the value of the assets went down, there was no income in the trust this year, they allow for you to have catch-up provisions later on. If you have an income retainer on this, on this property in the trust, and they don't pay you for 2 years, and the third year, if they can, they'll pay you. They can pay you. Okay, so this is a little more flexible, better for the charity and also for you, because you can continue to make contributions after the inception. What's today, Wednesday? If I have price appetizers and max, it's just a guacamole for $3. Can't do it. So I'll hear it. Okay, again, you've seen this before, just understand that the charitable is a remainder bit on this one. CRAT, same thing. Wait, hang on. Okay, now this is just an example. This was exactly what we mentioned earlier. You donate $1 million, you retain an interest of $300,000 through the annuity. Okay, they have these, it's a 720, 759 factor. Anyway, tables that they'll look at that, and the remainder that they calculate, okay, will be the charitable reduction at the end of the trust term. Okay, so that's basically all you're saying. Okay. Your book has a nice little table that talks about the advantages and disadvantages of both. Non-trust split interest charitable gifts. Okay, so there's really no split interest in here. There's no grantor, there's no remainder. Charity will get the property, but the person still retains the right to use it. So this is very much like a Cupid, okay, but it's going to a charity instead of to like a family member or something else. Now, just the same way the charity received the property at the end of the trust term and the grantor, retained the annuity interest, you can flip that. So I can donate property to a trust where the income for the trust term goes to the charity, and then at the end it goes back to my family. Okay, you get a deduction, okay, for the property, the amount of money that goes to and this is what they call a charitable lead trust. So understand the arrangement can be flipped. Okay, instead of the charity receiving property at the end, that family member or whoever else it just goes the other way. Used by high net worth individuals who do not need the current income, but desire to transfer future appreciation to the next generation. Oh, that sounds familiar. Okay, get a charitable tax deduction. A lot of flexibility, okay, in financial instruments planning. Okay. If you give at death, typically there is no deduction for income tax purposes. You will get the gross estate tax deduction, okay, there'll be a limited charitable deduction. But again, we did analysis at the beginning where you may not necessarily qualify for that because you're under a lifetime exclusion anyway. So sometimes it is best to give during life to take advantage of all the tax breaks that are provided.
What does testamentary mean again?
It's at the end upon death,
Um,
that, the transfer happened at death, or the trust began at death. Okay, I urge you, please, I know we kind of went over some examples, please look at the examples in the book, I don't want you to be surprised. Because there's a lot of, especially with the 20, 30, 50, 60% AGI limits, strategically planning on whether choosing adjusted basis or fair market value, and calculating the adjusted basis on property that's appreciated. Those are the 3 or 4 things I would definitely keep my eyes on for this chapter. Piece of cake. Some of you took a nap, some of you listened, right? It was experienced, enjoyed differently by all. Alright. We still got 2 days of case study to work on the big one. It's only 40 points, but it's more comprehensive, so that's good. We'll start with chapters, is this 9? What was chapter 10?
Chapter 9.
9.
Okay, that's gonna be another one. Y'all get ready, okay, there's gonna be some calculations, computations, on the limited marital reduction. So we have charitable, unlimited marital, so we're actually kind of going down the gross estate, if you think about it. Do you have any questions? Work on the examples, look at the assessments, we will have a quiz on this on Monday. Okay, same format, make sure you look at the practice quiz. Thank you all for everybody who participated in the Banking Expo today.